Think about a company that's, well, basically everywhere, a real retail giant. But how well do you really know its financial pulse, what makes it tick? Today we're taking a deep dive into Walmart Inc., ticker symbol WMT. We've got a pretty comprehensive stack of reports, recent earnings insights. We're going to try and uncover what's truly driving this powerhouse. Our mission really is to dissect Walmart's latest financials, understand its strategic moves, and also look at the challenges it faces, give you a clear, balanced picture.
Right, and the goal here is to connect those dots for you between the raw data, the numbers, and the broader economic landscape. We want you to see not just the figures, but what they actually mean for a company operating at Walmart's massive scale.
Okay, so let's unpack this. What is Walmart Inc. today? I mean, we all know the stores, obviously. But fundamentally, it's a global leader in retail, wholesale, and yeah, e-commerce now too. They run supercenters, hypermarkets, Sam's Club, warehouse clubs, discount stores, the whole network. And their offerings are incredibly diverse. Groceries are huge, of course, but also health and wellness, clothes, electronics, even financial services popping up. It's classified as consumer defensive, which kind of hints at its role, right? People need essentials, even when times are tough.
And what's just fascinating here, maybe even easy to overlook, is the sheer scale. It's enormous. We're talking a market cap currently around $766.68 billion. But it's not just size. Walmart has what analysts call a wide economic moat. And that's not just jargon. It really comes down to two things: their incredible price leadership, being cheaper than most, and that vast physical store network. This combination creates a huge cost advantage. It lets them offer prices that are, frankly, very hard for competitors to match consistently. That keeps customers coming back. It's a really powerful edge.
Right, that mode is key. Now let's jump into performance. Their latest numbers, fiscal Q2 2026, came out August 21st, 2025. And the top line, the revenue, looked pretty robust, didn't it?
It did. Revenue hit $177.4 billion. That's up 4.8% year over year, or 5.6% if you strip out currency effects. And importantly, that actually beat market expectations for sales. So a strong start there.
Okay, beating on sales. Where did that growth really come from? What were the drivers?
Well, a lot of it is the digital push. Global e-commerce sales surged 25%. That's a big jump. And if you look inside that, Walmart US and Sam's Club US both saw 26% growth online. Internationally, sales were up 10.5% in constant currency. China, Walmex down in Mexico and Central America, and Flipkart in India were all strong contributors.
So e-commerce is really firing on all cylinders, but a strong top line isn't always the full story, is it? What about profitability? Did that keep pace?
And that's exactly the tension here for investors. If we connect this to the bigger picture, yes, sales were strong. But adjusted earnings per share, the EPS, came in at $0.68. And that was just slightly below what analysts were expecting, the consensus estimates.
Okay. So that immediately flags something. Great sales growth, but profits may be feeling some pressure.
Precisely. It tells you that maybe the cost of achieving that growth or some other headwinds are starting to bite into the bottom line. We need to look into that.
Interesting. And looking quickly at the stock details. The last close was $96.71. Now, the reports we looked at have a bit of a range. One indicates a fair value around $103.61. Another recent earnings review put it near $103.12. But then our internal price target from one report is actually lower at $91.38. That's quite a spread.
It really is. And that spread tells you something, too. It suggests analysts are weighing things differently, maybe focusing on different aspects, long-term versus short-term, perhaps.
Yeah, that makes sense. Now, here's where I think it gets really interesting. Walmart isn't just, relying on the old playbook. They're actively pushing this idea of a two P&Ls business model. That sounds like a pretty fundamental shift. What does that actually mean for the company and for you listening?
It's a very strategic move. The two P&Ls idea is about integrating their traditional retail, which often has, let's face it, thinner margins with a growing, much higher margin digital business. So think of it like running two distinct profit centers under one big roof. Good examples are their global advertising business. That grew an impressive 46%. Walmart Connect in the U.S. was up 31%, even excluding Vizio.
Wow, 46% growth in advertising. That's huge. They're really going after those ad dollars.
Exactly. They're competing directly with the likes of Amazon and Google there. And then you have membership income, like from Walmart Plus Beat. That was up 15.3% globally. These aren't just side hustles. They're deliberate efforts to diversify how they make money and boost overall profitability over time.
So building these new higher margin businesses alongside the core retail makes sense. But beyond that, they're also pouring money into tech and efficiency, aren't they?
Oh, absolutely. Huge investments there. They're automating supply chains in the stores and clubs using more advanced AI and technology across the board. We're talking about things like developing AI super agents for internal tasks, a customer-facing AI assistant called Sparky to help shoppers.
Marky, okay.
Yeah, and expanding things like dynamic delivery windows. They aim to cover 95% of U.S. households with that by year end. That's massive reach. Plus, they're launching a new one-pay cash rewards credit card, 3% back at Walmart, 5% if you're a Walmart Plus member.
Ah, reinforcing that membership value again.
Exactly. It's all about strengthening loyalty and making that Walmart Plus subscription stickier.
It seems like management feels pretty good about these strategies then. They actually raised their full-year guidance for fiscal 2026. Sales growth now expected between 3.75% and 4.75% in constant currency, and they nudged up the adjusted EPS outlook slightly too, to $2.52 to $2.62.
Yeah, that guidance bump signals confidence. They clearly believe these investments, and the 2P&L model will start delivering on the bottom line despite some current issues.
Okay, so lots of positive momentum and strategic shifts. But, as you hinted earlier, the reports also highlight some pretty significant headwinds hitting profitability now.
Yep.
Despite all the forward-looking stuff, what are the key concerns investors should be aware of right now?
Yeah, this raises an important question because the pressures are real. The first big one was unexpected. A jump in general liability and workers' compensation claims. That forced them to add an extra $450 million accrual just in Q2.
$450 million.
Wow. And that created what they called a 560 basis point headwind on adjusted operating income growth. That's 5.6 percentage points knocked off, a substantial hit.
Ouch. Okay, that's significant. And tariffs. Those are still hanging around, aren't they?
They are. Tariffs are definitely pushing up the cost of goods they import, and they expect that to continue through Q3 and Q4. And it's having a real effect. They noted it's moderating unit growth, especially in discretionary stuff, non-essentials, particularly for middle and lower income shoppers who are feeling that price pressure more.
Right. People cutting back on the wants versus the needs.
Yeah.
Any other areas causing margin pressure?
Well, a couple of other things. Their international e-commerce, while getting more efficient, is still running at a loss overall. They're working on it, but it's not profitable yet. And gross margins were also squeezed a bit by the sales mix. People bought more lower margin groceries and health items compared to general merchandise, which usually has better margins. That shift naturally drags down the overall margin percentage.
So a few different pressures converging there. How is Walmart fighting back against this? What are they doing to manage costs and, crucially, keep those prices low?
They're being quite proactive. They're managing inventory carefully, obviously, and pushing initiatives like more price rollbacks. Over 7,400 rollbacks in Q2, they said, including a 30% increase just on grocery items. That helps keep customers happy and reinforces their value image.
So absorbing some cost to maintain that price leadership.
Exactly. And they're also leaning on that flexible business model we talked about. Those higher margin advertising and membership revenues help offset pressure elsewhere. It gives them more levers to pull. It's definitely a balancing act, though.
Okay, let's loop back to those valuation numbers we mentioned. Stock at $96, price target from one source at $91, fair values around $103, analyst average way up at $113. That's a real mix. What's causing such different takes among analysts? How should you, our listener, interpret that?
It really reflects that tug of war we've been discussing. You've got the bull case. Strong core business, great top-line growth, exciting new strategies like ads and AI that promise future high-margin growth. Then you've got the bear case. These very real current cost pressures, the claims, the tariffs hitting short-term profits right now.
Right. Two competing narratives.
Exactly. And different analysts, different models, they just weigh those narratives differently. Some focus more on the long-term potential. Others are more concerned about the immediate profitability headwinds. For you, the listener, the takeaway is you need to decide which narrative you find more compelling right now. Are the long-term changes powerful enough to overcome the short-term pain? Or are the current pressures too significant? It requires your own judgment.
That's helpful context. And one final detail that jumped out from the report's insider trading activity.
Right.
We saw sales from top executives like John Furner at Walmart US and Catherine McClay at Walmart International shortly after the Q2 earnings. And looking broader, the quarterly data shows insider sales consistently outweighing any insider buys, sometimes by a lot. So what does that tell us? Should that be a red flag for someone considering WMT, especially with that mixed analyst picture?
Well, it's something to note for sure. Insider selling can happen for many personal reasons, diversifying assets, taxes, planned sales. It doesn't automatically mean they lack confidence in the company. However, when you see a consistent pattern where sales significantly outweigh purchases, especially around earnings periods or amidst known headwinds, it is another data point to factor in.
Adds a layer of nuance.
Exactly. It adds nuance, particularly given the profitability pressures we've discussed and the generally uncertain economic climate. It doesn't mean sell, but it suggests, maybe doing a bit more due diligence, looking closely at the full picture, including what management is doing with their own shares.
Okay, so bringing it all together then.
Mhm.
For you, our listener, what's the ultimate takeaway from this deep dive into Walmart today?
I think the key takeaway is that Walmart is this incredibly resilient retail titan, right? It's strategically evolving, pushing hard into digital AI advertising to secure that long-term growth and find higher margins. That's the positive forward-looking story. But at the same time, it's navigating some very real, significant near-term headwinds impacting profitability, those unexpected costs, the tariffs, the margin mix. So the real insight here is about weighing those two things. The company's enduring strengths and its smart investments for the future versus these persistent current cost pressures and the resulting mixed signals on profit. It's a classic situation, really. A fundamentally strong business operating in a really complex, challenging environment and trying to adapt.
Yeah, a giant adapting to the future while fighting today's battles. Very well put. Well, thank you for joining us on this deep dive into Walmart Inc. We really hope this gave you a clearer, maybe more informed perspective on this retail giant. If you found this discussion valuable and you want to stay ahead with more analyses like this, please do remember to subscribe to our channel and hit that bell icon too. Your support genuinely helps us keep bringing you these in-depth explorations. We really appreciate you tuning in.